Welcome back to Brave Ideas. I'm your host, Chandler Parker, and this season was recorded live at Juicy's 50th edition in New York City. For years, much of the flex office industry competed on convenience. Today, more operators are competing on something else: brand, experience, identity, and the simple reality that customers are willing to pay more for spaces they generally want to spend time in. My guest today is Flip Howard, CEO of Lucid Private Offices. Flip has spent more than 2 decades in the industry and successfully transformed his business from a traditional executive suite serviced office operator into a premium private office brand with a clear point of view. In this conversation, we explore why brand matters more than ever in office real estate, how Lucid repositioned itself around a premium experience, the relationship between co-working, private offices, and profitability, why consistency across a portfolio matters, and why fundamentals still matter even as the industry chases new operating models. This is a conversation about positioning, discipline, and creating something customers actually remember. I hope you enjoy. Let's jump in. Welcome to Brave Ideas, Flip.
Thanks for having me.
We should have done this like years ago. You've been doing this industry for 25 years.
I have.
And it just took Liz Elam to bring us together.
Liz is the great connector.
He is the great connector. And we're here at Juicy 50th edition, Manhattan and J Suites for another episode this season. So thank you for joining. What I want to dive into is the premium aspect of your brand. We're going to cover a few things here, but our industry, where historically we've had a lot of, shall I say, kind of boring. I'm going to be a bit rude here for a moment, maybe for some people, but we had some sort of boring aesthetics and middle market brands, which has a place for the market, but there's been a movement from the demand side of people who want substance, who want cool aesthetics, Instagram worthy, premium feel, and you guys are delivering on that. So you guys on the website described Lucid as a place to work, not play. What's the story behind that?
Yeah, it's a good. So our company motto is work is good where you do it matters. So the first part of that, the work is good part, is kind of an underappreciated concept, I think. And we kind of built our brand around that. From 2001 to 2017, we were just like a Regis copycat executive suite. We were called Meridian Business Centers. We were all the things you were just making fun of. Basically, we were boring, dark, depressing executive
You see what I did
suites.
there then, right?
Yeah, I did. Okay. Yeah, that was good. So that's what we were. I had a business partner. I bought him out beginning of 2018. That's when we pivoted to kind of our new look and feel. And that's really, after 17 years in the business, the first time we really spent time thinking about, like, what do we want to be as a brand? What's our niche? What's our competitive advantage? You know? And that's when I thought a lot about this whole concept of work is good. And I felt like the understanding of work, there was a pendulum swing that happened. It went from, hey, you got to do it. Work sucks. Just come to work and shut up. There's yellow lights and drywall and it's gross. So just come here and shut up. And then it sort of pendulum swung to this, yeah, work still sucks, but come here and play and have beer kegs and ping pong and whatever else and just kind of escape from work while you're at work. And we're like, why? Why can't we do something that's halfway between? That is premium, where we actually embrace the concept of working, but it doesn't have to be depressing and energizing. So we try to build our whole brand around kind of that concept.
You said the word niche earlier. For my UK audience, we say the word niche, but there's a phrase in the US that doesn't really work in the UK. It's called niches to riches. Have you heard that? Have you heard that before?
I've never heard that before, but it makes sense. I look forward to it happening to me. Yeah, I do think it's an underserved niche. That's one of the reasons why it's not like I felt like, okay, the premium private office focused co-working slice is the best. I still don't feel like it's the best. I feel like depending on who it's for, there are flavors like to the left and right of me that are both the best for certain audiences. Like, there are value providers that are kind of boring office space, but it's really efficient and it's really, for companies that are cost cutting. And I think that's great. And there are very casual spaces that are very fun and playful and people need to meet each other and expand their networks and do all this. And I think that's great for them. For us, this was a slice that I felt like was underserved. I felt like I didn't know how to be cooler than, I'm good friends with Nick Clark. I run Common Desk. Like I always said, I didn't know how to be cooler than Common Desk, but I knew how to be cooler than Regis, and I didn't. So anyway, we found this niche that I felt like was underserved. I felt like it was going to be easier to find people who were looking for something that I was kind of, yeah, people started looking for something between the two that was, I wasn't swimming in the pond of all these cool casual co-working spaces, but I also wasn't the same as all these really old dated things that had been built out 15 years ago. And it was something new and different. That's what we've been doing for the last, I guess, 8 years now.
This is the whole essence of brand is knowing who you're serving and building, putting your values front and center, building around that and attracting the people that believe in that. So it sounds like you've done that. But you also, whilst you have private offices, you also have co-working, and you've sort of taken a middle ground approach to take the best of both worlds. What was it that you saw about both models that you could fit together in the right way that's going to deliver a positive P&L?
That was the tricky part, because I used to use the analogy a lot. I haven't said it in a while, but nobody wants a convertible minivan, meaning like if you try to combine the best aspects of a convertible and a minivan, you might end up with a convertible minivan, and nobody wants that. So you can't just blend the two and know that it'll work out. You had to pick out like the best parts of this one and the best parts of this one. So for me, from the co-working, more casual co-working side, that was community, it was light, it was energy, it was customer-friendly terms, it was non-legalistic agreements, not holding people to the kind of real estate contract kind of situations. And then from the executive suite side, it was simple math. It was revenue and expenses, and it was privacy, and it was professionality, and some of those things. And so we really have even gone so far in our design to where every element, like literally our floors, our walls, and our ceilings, we said, okay, what would a Regis do and what would a WeWork do? And we're doing neither of those things. So what's halfway between those two things? And that's kind of what we've done everywhere.
So can you paint a picture for the people who aren't watching today and just listening? What does that even look like?
Well, like in a physical design, it's so like our ceilings are not industrial open, like warehouse style ceilings, and our floors are not hard concrete floors like you would have in a WeWork, and our walls are not all glass like you find in an Industrious or WeWork, but it's also not all carpet with a 4-inch base, drywall walls, and white ceiling tiles. We didn't do that either. So what it looks like is, everyone says this, but it's a hybrid of drywall and glass on the walls in the right places. All of our sight lines have natural light coming in. On our floors, it's a combination of hard and soft surfaces. It's either black ceiling tiles or it's wood or drywall or other kind of elevated ceiling finishes that are not white ceiling tiles. I mean, that's just the design part. But
And is that a copy paste across the entire portfolio?
pretty much.
Okay.
Yeah. I mean, there's obviously differences based on the floor plan
Sure.
and the layout, but yeah, if you walk into one Lucid Private Offices, you can pretty much expect what the next one will look like. And we still do actual reception desks, and there's boardrooms, but it's not the Regis style. Here's the reception desk, the boardroom's behind it on the glass. There's no activity here. There's always a coffee lounge where you can see, but you're not entering into the coffee lounge. There's some subtle differences. Honestly, I'm a little offended sometimes. I'll have people who I think I've created this really unique, amazing thing, and I'll have someone who's like in the business walk into one of our spaces, and they'll be like, "Oh yeah, it's nice, it's elevated, it's just like an Industrious." I'm like, "No, it's not just like an Industrious." But so I guess my point in that is a lot of the finishes are not apparent to a lot of people, but I still think they all make a difference when you add them all up.
We'll put a link in the show notes for people to check out your website and see the photos and so forth. I've heard it described, maybe I've even described it this way, is that the co-working brings the vibe and the private offices bring the cash. What do you think about that?
I think that's pretty much right. We even in our private offices, I mean, most co-working companies now get most of their revenue from private offices. They can talk about being a co-working company. I think co-working obviously is the umbrella term for our whole industry. But if by co-working you mean hot desk and dedicated desk and open space stuff, we do very little of that. So we have to find other ways to bring the energy. We do offer some memberships that are lower cost to get activation in the space, but also we have large team rooms that are all glass, that are in visible areas that bring in energy, so it doesn't feel like an executive suite inside. But our primary revenue is obviously derived from people renting private offices because they stay a lot longer and they pay a lot more.
How much of the design aspect of what you're copy pasting is specifically attracting that customer, your ICP that you're attracting? Is it design? Is it something else that attracts them?
I wish it were something else because I feel like we have a lot more to offer than that. But I think the design is what attracts them, and everything else is what keeps them. Like our community there we use the word driven because we're trying to find a non-pretentious way of saying rich people. Basically, our suites are a lot of decision makers. It's not a lot of younger employees. It's a lot of basically rich people who own their own things. And because of that, a lot of the spontaneous interactions and conversations in there they're just dynamic. They're talking about higher level things. They're doing cool things. And so that sort of spontaneous interaction that happens in our locations is really something that's hard to talk about on a website or even talk about on a tour and a sales pitch. You're gonna have to be there to see it. So really, I think the design is what draws people in, but it's the same crowd. Like the kind of people that are drawn to our design kind of want that. These people generally have their own families and their own lives, and they don't want to spend a whole bunch of time at work. You know, they've got a whole friend group. They don't need to make a bunch of new friends, but they don't want to be bored all day either. Like they like just the right amount of social interaction. They like just the right amount of conversations with people doing cool things. And so I think the design draws in the kind of people that end up interacting well with each other in a way that I honestly didn't plan. It just kind of happened that way. We didn't really plan on being premium, honestly. We were trying to just be halfway between a Regis and a WeWork. And we were going to be equal level. We were just going to be, look, this one's very casual and playful. This one's very stuffy and professional. We want to be kind of halfway between, like a little bit stuffy, but go ahead.
Is that because you recognized in the tours that you were having, the feedback you had from customers, the deals you were closing, that there was an existing demand for somebody who didn't want WeWork or Regis, they wanted something different?
Yeah, that, and again, we were just a Regis copycat for a long time, and it was so funny. We had to be cheaper than Regis to win deals for 15 years, and now we're double the price of Regis, and nobody cares. It's been funny to watch that happen. So we started out just trying to be halfway between the two, and this whole kind of elevated to them thing that's happened was sort of an accident. We just realized that, oh, if we're like an executive suite, but we're more modern, and if we're like a co-working space, we're more professional, that actually does create something that draws this kind of more upscale audience. That was just kind of an accident.
It's interesting what you talk about, the dynamic interaction being spontaneous, whereas a lot of the brands out here that lean more towards the co-working side, they invest heavily into the curation of the community, the events programming, and so forth. Are you not having to do that because of the certain customers that you have?
Having to isn't, I don't know if it's right. We probably would do better if we invested more in it. We invest a little bit in it. We're kind of halfway between. So I would say we invest in programming more than executive suites do and less than a lot of casual co-working spaces do. I think we would do better if we invested more. I think we have a ways to go on that. We've got a few locations that are really good about it, where we have a really active, cohesive community, and there's always a waiting list and there's a line for the bathroom. And those places tend to have more, again, those just sort of happen based on various personalities. But I think if we put more effort into doing that in the way that a lot of co-working spaces do, we'd do even better.
With the areas that you focused on, you could do more of investing in the community and in the events. The other folks that are, do you think they're doing something wrong that maybe you don't want to repeat?
No, I'm honestly kind of jealous of some of the stuff they're doing. Yeah, I feel like, again,
you heard it here.
I look at some guy. Yeah, I actually was getting together with a guy who owns Kiln recently, and they're a more casual co-working space, but it's a very premium casual. Premium casual is an interesting combination of words, but they are that. And they do a fantastic job of programming stuff. And I was kind of picking his brain on that kind of stuff. Yeah, I really wanted to do more of that kind of stuff. I think if you were to ask what the two sides do wrong, I do feel like the kind of old school executive suites, I think what they do wrong, and they're a bit limited by the space. Like the space is built out in a way that kind of makes it not conducive to doing cool things, but they're a lot of times kind of stuck in a yesterday way of doing business in a very legalistic sort of, P&L driven way. And then, like I talked about before, the pendulum swing, the co-working side of the business, or the casual co-working side of the business, tends to be a little bit too uninterested in things like revenue and expenses and per square foot metrics, and a lot.
The premium aspect, and appreciate what you said about premium casual. The Malin's another one I think could fit in that category. Amazing design, but you don't feel like you have to be in a suit and tie when you go in there, right? In your case, do your customers, or are they wearing suit and ties all the time?
Yeah, no, not at all. And it's funny, like when I talk about the convertible minivan theory that I was talking about, I think you saw, I don't know, 7 or 8 years ago, the first people that tried to do premium co-working were doing that. It's like, we're going to do all hot desks, but everybody needs to wear a sport coat. It's like, I mean, that's
Like
a
a
bit of
members
an
club or
exaggeration,
something.
but it's like that's
Yeah.
the worst of both worlds. That's a convertible minivan. Like nobody wants to wear a sport coat in in a co-working casual open desk thing. Our spaces are basically people mostly like this. I mean, yes, we have some lawyers in there who are wearing a tie, but it's very few. We have, some guys in backwards baseball caps and headphones on in the kitchen, but not a whole lot. That's not, neither vibe is dominant. It's a pretty, probably everybody says this, but it's a pretty nice, cross section of everybody. And we do that intentionally. Like we build out certain types of offices and certain price points to get that. I think if you have all young people, the old rich people don't want it. If you all old people, the young energetic people don't want it. You have to kind of curate that a bit.
Hey, everybody, I'm breaking into the podcast. My name is Liz Elam. I'm the founder of Juicy. And I wanted to break in and let you know that there's other ways to be connected to Juicy. So you can join Juicy membership if you go to juicy.co, which is gcuc.co. On membership, you can find a really great deal right now. We're running a summer series. And in July, we're in the middle of it. And our second speaker is going to be on at the end of July. So definitely look at joining membership, which is also a great way to get discounts to juicy events in live, in person, in real life, which is where we all want to be right now, is in real life. That is the future. In September, we're going to be in beautiful Cape Town, Africa, doing Juicy Africa for the first time. Antoinette is working really hard on that event. Head over to africa.juicy.co for more information and to get your tickets. Then in October, we're back in London, which is always such a great event. London is such an amazing city. It's so vibrant. The scene is incredible. You should definitely consider attending. You can get information there on uk.juicy.co. Emily is working her tail off, and it's going to be epic as always. And if that wasn't enough, we recently announced that Juicy USA 2027 is in one of my favorite cities in America, the vibrant, the amazing Miami. Early birds are up. They're never going to be this cheap again. So also look at juicy.co for a link to Miami early bird tickets. That's the only place you'll find those tickets. Anyway, we're over here busy thinking of new and exciting ways to educate you guys and inspire you guys. Hope you're enjoying the podcast. We had such a great time at Juicy's 50th with Caleb and Brave, and now I'm going to turn you back to it.
You talk about how the office or a company's office is a representation of their business and their company.
Mm-hmm.
Do you think that the premium and the aesthetics that you're delivering and the vibe that you're curating there is that what's driving your ICP to come in because they think it's a representation of their business?
It's a big part of it. Like we do white label in a way that I don't think there's anyone else of our scale that's doing it. Meaning if you walk into one of our reception areas, our name is nowhere because we say we're about your brand, not ours. So it doesn't feel shared or temporary. So for certain industries that have clients coming in, that's a big lure. The fact that you walk into this fancy marble floored room and it looks like your whole office rather than kind of walking into a WeWork or walking into an Industrious with their name splashed everywhere, it feels very shared and temporary. So for our members that have their clients come visit, that's a big thing. But we have a lot, I would say, at least half of our clients don't really have a lot of clients come visit. And they're not just drawn to the image that it conveys to their visitors. They're more drawn to just the attitude in the space of, we use the word, it sounds weird, but like productivity, which just means that it's not people playing, but it's not people with their doors shut either. You can see this kind of hive of energy. You see a lot of meetings going on. You see people working, having quick conversations and moving on. There's just kind of an overall vibe of it that is informed by the design. It's intentionally not, we have a smaller amount of our space dedicated to open areas than most on the co-working side, but more than everybody on the executive suite side. But that design is intended to bring about that kind of culture or ethos or vibe or whatever you want to call it of kind of professional without being stuffy, energetic without being casual. It's a hard thing to talk about on the website though, because you're like, we're like the porridge that's not too hot and not too cold. And that's just not a sexy, tagline.
Yeah.
But that's kind of our deal.
Correct me if I'm wrong. You guys are all in on the lease arbitrage model.
Correct.
And while a lot of other operators are doing hybrids or doing management agreements,
deals, yeah.
Joint ventures, profit sharing leases.
Yeah.
you're all in on lease arbitrage.
Yeah.
Why have you focused on that?
I don't think that the management model is bad in theory, but I think it ends up being bad a lot of times. And when I talk to landlords, there's several reasons. One is the best location. You need to be in a good location for this. This doesn't work everywhere. Our model does not succeed wherever you drop it. The best locations, those buildings know it and they're pretty proud of it, and they're not wanting to do a management deal. And if they did want to do a management deal, you're basically trading upside for downside protection, right? And it's just a matter of who absorbs the risk. And if they're going to absorb the risk of the downside, they're going to want a bunch of premium for the upside. But the problem is twofold. One, they're valuing that upside at like 50 cents on the dollar at best. They're not really. I've been doing this long enough to where, like, when I look at a building, I can tell you, I can pro forma it pretty closely. Like, I'm not worried about it going out. I'm not worried about it not performing, and I know exactly what it's going to do. And so they don't have as much confidence as I do in what it's going to do, and they have a lot more fear for the downside than I do. So that math just doesn't work out for the negotiation. I don't want to trade the upside for downside protection that's kind of irrelevant to me, because I wouldn't be signing this deal if I didn't know it was going to succeed. One of the biggest problems I have with management agreements, it's not with management agreements itself, but it's the way they end up playing out a lot of times, is the lack of vetting. You'll see so often, a particular brand will go into here, and then they'll do another deal here that'll totally cannibalize that deal and torpedo the other location because it was, less than a mile away, but they had no skin in the game in either one of them. So why not? And, I know that after 2020, a lot of people in our industry were all in on management deals. But at the end of the day, if a location works, it works. It's not like it's working under one structure or not under another structure. If a location is going to be successful, it's going to be successful under either structure. And if it's going to fail, it's going to fail under either structure. It's just a matter of who bears the brunt of, when it fails, or who gets the reward of when it succeeds. And so, yeah, for me, I talk to a lot of landlords about the management thing. And I love the alignment of interests. I love that it creates more of a partnership instead of a kind of a tenant-landlord relationship thing. But there's just a lot to watch out for in terms of the vetting of it.
No, I appreciate the focus on lease arbitrage, and you're right. In certain locations, if you're going to really kill it, you're going to want to keep all the upside with that. When we were in our last session with Cushman & Wakefield, one of the things that came up was, even when you're going out and acquiring space on the lease model, because landlords are now leaning into that profit share model more today, they're being more selective. They're putting up a lot of barriers to even doing lease deals. And so are you finding that when you go out to acquire new space, you're actually having to pitch that landlord on you?
One, yes, there are a lot of landlords that are not receptive to co-working at all, they're kind of averse to co-working, and we're having to pitch them on us. Happens all the time. In fact, some of our best, I'd say not most, a high percentage of our best recent locations, the landlord originally didn't want us, and we had to basically talk them into it over a period of time.
Why didn't they want you?
Because they think of co-working, and I tell them this, if you don't vet co-working strongly, I kind of don't respect you as a landlord, because I get it, because there's been a ton of bad co-working deals done. And that's the reason why they don't want us. They've either had other buildings or had friends who've had other buildings who've had a bad co-working deal done, and they're skeptical of co-working. They kind of paint us with that same brush. And everybody's had tech companies go out of business too, but they'll still sign a deal with the tech. And for whatever reason, co-working has a little more of a negative baggage with it. Whenever one goes bad, it drags the whole thing down. But that's one reason why I talk to a lot of friends in the industry and friends on the building ownership side to try to prevent bad deals from happening. So I think it kind of is an albatross hanging over all of us. But back to your original question, I would say that yes, very often for me, it's all about being in the right location. And I can have the perfect lease structure in a bad location, and I will pass on that deal 10 times out of 10 versus a pretty good lease deal in the perfect location. It's like, location, retail sort of thing. So to get the best buildings, usually very rarely are they asking me, hey, we'd rather do a management deal than a lease. As soon as you say you're willing to do a lease, they don't want to talk about management deals, hardly ever. One or two out of the last 50 conversations I've had like this, one or two exceptions to that rule where they are preferring a management deal because they want some upside. Yes, it's getting more popular, but most of the buildings that management agreements are getting more popular in are, class B and C stuff that they basically can't sell the space to anybody else. And you've seen this bifurcation happening in the office where the A stuff's getting way more expensive and the B stuff's getting way less desirable. And so you're seeing, we've had a national brand that does all management deals go into a couple of our locations that we left when our lease was up, that we were in for 10 years and left because it was too B for us. And that building couldn't lease that to anybody else at a market rate. And so they're doing a management deal to just try to get something and basically cut their losses on it. It makes all kinds of sense in that thing. We've had some conversations recently, to be totally transparent, on the opposite end of that spectrum, where we've had some buildings that we aren't comfortable signing the lease because it's too expensive. But I tell the landlord, like, I'm willing to do a management deal at this. And they have, I think, wisely punted that deal, because if I'm not comfortable putting my name on it, I don't know that they should be either. It's just outside of my pricing model. I don't know if I can get $900 a desk here to make the math work on a $65 building. If all my other buildings are $40 to $45 and I'm charging $500 a desk and that's working, yeah, I'll do a management deal here at some higher price point I've never done before. But
you haven't done it. You haven't done it.
No, and if I were their friend, I would recommend them to not do that.
Well, I think there's a lot of innovation happening in the industry, but the fundamentals still exist that have been around for 25, maybe 40 years now. Even though we are moving into a new way of working, the math still is the math, right?
And there's still math. There's still revenue and expenses. We're just, we don't have investors. We don't have debt. We just grow out of cash flow. I need every building. I'm not interested in dots on a map for some hypothetical valuation. I need revenue to be here and expenses to be here, kind of from day one, going on. So that's the way we do deals. And we're able to talk landlords into doing deals with us because I use the stat. We've made 4,000 consecutive timely monthly rental payments. We've been doing this for 25 years. We got a bunch of locations and we've never missed one, even through COVID. And that will sometimes convince them. Okay.
Is that?
Yeah. Oh yeah.
Them? Okay.
Yeah. In bold, big writing. Yeah.
Okay.
But still, it doesn't matter a lot of times. They've been burned by 3 other co-working operators. They don't want to hear, they don't want to hear it. And again, I don't know that I really blame them. There's a lot of people that have been burned by bad co-working deals.
Well, flipping that, for the landlord that does want Lucid, what would you tell them? How can they be the best partner for you?
It's all about matching the building, the supply to the demand, basically. Does the local area support this type of space? Because I've had a lot of conversations with landlords where I'm like, I'm not the best fit for you. This other type of fit is. So I need to be, again, if it's a building that's $60 or $70 a foot, I'm not the best fit for that. If it's a building that's $25 a foot, I'm not the best fit for that. If it's a building that is urban core, a lot of just, Gen Z employee base taking public transportation, I'm not the fit for that. There are certain price levels and also certain styles that work in certain markets. So we've got kind of a model. We're in generally affluent suburban, but office markets that have a lot of Class A office buildings. So we don't do too rural, but we don't do CBD downtowny kind of stuff. So if you're a landlord in a southern growing major metropolitan area with a, Class A minus building that's not $60 a foot, that's in a great demographic area that has Lululemon and Tesla stores nearby, we're in.
It's knowing where your customers are.
Yeah.
The concept of premium goes down to knowing who your customer is, delivering the brand, but then it also goes into how much you spend on your CapEx to deliver the aesthetic and what that brand looks like. Is there another piece to the premium beyond the design and aesthetic?
Yes, and I would modify one thing you said a little bit. You said how much you spend on your CapEx. You would be shocked at how much people spend sometimes for mediocre looking CapEx. I would say you can get more than you think when done right. That's a whole different conversation. But, we build out our spaces for a lot less than a lot of our competitors that you would assume the opposite walking in. But is there more to it than just spending that money? I mean, yes, obviously there's the customer service side, the corporate culture side. We're pretty obsessive. Everyone says they are, but, it is easier as a local or regional player to deliver on the real community and the real customer service in a way that a lot of the international and national players kind of can't. And a lot of our customers are drawn to that element of the premium thing too, the real kind of white glove side of thing.
In the hotel industry, if you compare value brands, mid-market brands, and premium brands, the premium brands always spend more money on the CapEx. They will have the marble floors and, amazing, beautiful vibe and feel. But sometimes the margins are lower. The EBITDA can be even lower than the mid-market. The mid-market might be spending less, but even though the premium's charging more, there's more margin over here. How does that play out for you?
We value engineer all of it. For me, the value engineering side of it comes in the architect side. We've used the same architecture group for 17 years now, and each one that goes, we value engineer, and so like I said, we deliver a product that you would think costs 50% more than it does. In terms of the kind of premium pricing and the margin, we intentionally, for good or for bad, we price a little lower than we probably should, given the luxury level, if you want to call it that. And we try to keep a higher occupancy. So whereas maybe a lot of my other competitors, maybe they would charge $700 a desk and be doing great at 80% occupancy, and maybe we're charging $550 a desk and really needing to be 85 to 90% occupied. That's kind of been more our model for two reasons. One, because of our design and our whole kind of company ethos, we do over half of our customers, the person who writes the check is actually in the office. So there's a lot of founder-led companies and, solopreneurs in the office, and they just tend to be more price conscious, so we have a hard time charging what you could charge if we had 70 or 80% of our customer base be national brands. That's one reason why our pricing model has been like that. The other is just for activation. It just crushes my soul to see empty offices. It just feels like waste. So if I have a location that's 75% full, but charging a lot, it still feels dead inside. And when it's 92% full, charging a little less, it's just got this hive of energy about it. And it tends to self-sustain and never drop from there. So those are kind of the reasons.
Well, I think the equation there is around the churn, because churns can be expensive. If you're maintaining a high occupancy, churn isn't as expensive. Because the void period and the cost of new acquisitions. What does growth look like for Lucid?
Yeah, we're in full growth mode right now. I would say 2025 was our first really, really good year since 2019. 2020 was obviously a disaster. 21 through 24 was kind of a slow climb back, but not dramatic. And last year was very dramatic. And so it still feels like that. Last week actually was our best week we've ever had. It was awesome. So we're in full growth mode. We're talking to 10 to 12 buildings right now. We'll probably add 7 or 8 new locations this year. We're doing kind of copy paste of the same types of buildings we're in now. We're doing Sunbelt growing cosmopolitan markets. So we're in markets where we can put at least, 3, 4, 5 locations in, in a major kind of NFL sized city in the Sunbelt. And we're not downtown. We're just kind of doing what we do in those markets, and we'll keep doing that. We grow, just like I said, out of cash flow, so we don't have like a board and investors and debt or any of that stuff. We're just super simple, old school revenue and expenses.
I was actually halfway expecting you to come in with a baseball hat backwards, like you were talking about your customer earlier. Because when we had our prep call, you were wearing, you had your hat backwards. I was like, all right, maybe I should wear mine too.
When you called me yesterday morning, I had just gotten home from tennis and I had my hat on. My glorious long hair gets in my eyes when I play tennis, so I had to wear a hat. And
Glorious, love it.
Glorious. And but I was holding my 2 granddaughters in that.
You
thing.
were.
So sorry about that. They were a little distracting. But
beautiful blue eyes.
They're the joy of my life right now. It's so fun.
As they should be. I want to just touch on this last question about the growth. And we also, in the last episode, we're talking about Enterprise Flex. Your customer base, your ICP that you're going to be copy and pasting and going after for that demand is your solopreneurs, people that are signing the checks, that are sitting in the office. How much of your customer is enterprise?
So it's growing, and it's been a big topic of conversation in our company, because we've always appealed more to the solopreneur. I take of as meaning one person. We obviously do a lot of founder-led, 1 to 10 person companies, as well. It's changing because a lot of those people, the small 1-2 person operations that used to need an office, now since COVID, basically don't need an office anymore. They work from home. So we've lost a lot of that core customer base, and it's been replaced by a lot of corporate, hub and spoke, hybrid work model kind of enterprise business. Not that it's enterprise in terms of they take a ton of our space. We'll never give more than 10% of one of our spaces to a customer, actually.
Can you explain why?
Yeah, just because we want to always stay full. So most of the locations that I've looked under the hood at that have failed because one customer had 20 and then 30 and then 40% of their space, and then they left because it was not cost effective kind of by definition, or they had to squeeze the margins so low. You can just get a lot better margins when you're charging someone, for a smaller amount of space. So it takes us a little longer to fill up than any of our competitors, but then once we get full, we tend to just stay full forever because we don't give a huge, chunk of space to any one customer. Back to your original question about the market segments. So we've lost a lot of our individual entrepreneurs, but we've gained a lot more enterprise business, and we're making small changes to do more. And when I'm talking about enterprise business, I'm still talking about 1 to 20 person requirements just from a big company. And that's getting bigger and bigger. And we're, doing a better job of appealing that. We're still kind of new at that. We didn't used to do much of that at all 5 or 10 years ago. And now we're figuring that part out. They're less cost conscious. They're great customers. And I think that is only going to continue. The gig economy is still booming and kind of probably always will. So I think there will always be a lot of tiny micro entrepreneurs, but it's hard to just sign that many deals a week, if you would do all little onesie twosies. So we're pivoting and doing more and more larger deals, but we still don't want to be the kind of company that caters only to enterprise, because I just feel like there's not enough margin there.
Is there a thought process around the makeup of the mix of people and what an enterprise footprint might do to the vibe?
Yeah, for sure. And we every time we build out a space, we're taking into account what kind of neighborhood is it in, how many big team suites versus how many small one persons do we have. And it's not always simple, because a lot of our larger enterprise customers take a whole bunch of small offices. They don't all just want a bullpen room together. So sometimes a whole bunch of small offices is what they're looking for. Yeah, it's a bit of a guessing game still. We've definitely swung and missed on a few. We've got a few that I could have sworn were going to be very enterprise friendly locations. We built a bunch of big team suites and they can't keep those full, and all the little ones are, full, and vice versa. But, we're getting it right more with a higher batting average every time we do one.
Well, thank you for sharing all of your insights, sharing some sweet tea with me. And this has been fantastic. I think recapping, it goes down to understanding who you are, who you're serving, really targeting your ICP and delivering for them. In your case, it's a premium experience.
Yeah.
So thank you.
Thank you.
Thank you for tuning in. Until next time, take care of yourself.